Well, joining us live from CommSec now, Tom Piotrowski for a look at the markets today. Tom, how are we looking?
Pete, we're going to kick off with a deficit again, which is a common theme as far as recent days have been concerned. The futures are pointing to a decline of 0.2% for the ASX 200. Again, reflecting what has been a broader downtrend for stocks in the Northern Hemisphere, and that's gone hand in glove with a move higher as far as interest rate markets have been concerned, both in Europe and the United States. And that's probably the point to make, Pete, is that over the course of recent days, be it in the US in the form of the minutes from the last FOMC meeting, albeit in the UK in particular, where we've seen stronger wages and inflation figures, we have seen the arrow firmly pointing higher as far as bond yields have been concerned, and that's what's creating the headwinds for stocks. Overnight, there was a rate hike from the Norwegian central bank, not necessarily on the lips of most, but it just highlights that broader trend that we're seeing, where the move higher is still the norm when it comes to what central banks are doing. And that's probably the interesting thing about what we are dealing with in the Australian experience right this moment. But I'll just reflect on the prices. In the US, the Dow fell down by 0.8%. We had the S&P 500 down by a similar amount. The NASDAQ was down by 1.2%, reflecting the vulnerability of tech stocks to rising interest rate. European markets likewise under pressure. We saw a pretty aggressive move higher for European interest rates last night. In the UK, the market down 0.2%. The French market down 0.9%, German market down 0.7%, the broader measure of European stock performance down by 1.2%. So what was interesting, Pete, yesterday we had that softer employment number. The day before we had that softer wages number, and that's been helpful as far as at least taking the sting out of the selling that we saw after the employment figures yesterday in local terms.
Okay, Tom, appreciate that. Thank you.